So it's important to have a retirement income strategy when you start taking distributions from your retirement plan, because if you don't have a strategy and a plan, you could do it the wrong way. My name is Sean Danziger with Net Worth Financial Group, and I specialize in working with employees of the phone company. Not everybody takes retirement distributions from their portfolio as soon as they retire. Some people do, some people don't. But at some point, sooner or later, everyone does need to start taking a distribution from their plan to have the income that they need to support their lifestyle. So the retirement income strategy that I use for some of my clients is called the Income for Life model, and it's a bucketing income strategy. And what I mean by that is, instead of having all your money in one bucket, so to speak, when you retire and drawing income from that one bucket portfolio, it's important to have multiple buckets. And the reason being, we don't necessarily know what the future returns of the market are going to be. And if in your first year of retirement, you're taking a distribution from your plan and you don't have a backup plan in the event that the market crashes that first year, for example, well, now you're going to be drawing your distribution, taking your income from this one bucket of your portfolio when it's down. So let's look back at 2008 when the market crashed. If you had $1 million in that portfolio, which came from your pension and your 401k, and now it's in your IRA in this one bucket, and you didn't have a plan like the one I'm describing and going to describe further, you would have been drawing your $2,000 or $3,000 a month out of that one bucket as the prices of the portfolio, as the portfolio itself is taking a nosedive as the market has crashed. So you don't want to sell shares in your portfolio so that you can redeem and pull income out of it as it's going down, right? We want to buy low, sell high. And in this case, you're selling low because every time you need to take your $2,000 a month or $3,000 a month out of your portfolio and the market's going down like this, you're locking in those losses. That's what we want to try to avoid with a bucketing approach. The bucketing approach basically means that we're going to have one or two buckets along your retirement timeline, which could be 30, 35 years for some people. We're going to have the first couple of buckets, which might cover the first 5 or 10 years of your income distribution period, right? The first 5 or 10 years of retirement, let's say. And we're going to have very conservative investments, maybe cash and other conservative instruments like short-term bonds. Now, these first two buckets are not meant for growth. They're meant for stability. So think about it this way. If the market crashes or the market goes down dramatically and you're not anticipating that and you have all your money in this one bucket, again, you're going to be taking money out while the account's going down in value. How about this? How about we have 3 or 4, maybe 5 buckets that are focused on growth, and the first 1 or 2 buckets are focused on stability. And as we get further out on the timeline, those buckets that are focused on growth investments have time to recover if we're in year 1, 2, 3, 4, or 5, let's say, because we've got 5 to 10 years before we need to touch the growth investments. So if those investments have time to grow, we don't have to worry about the volatility of the ups and downs of the market. We just have to worry about the ups and downs of the market as it pertains to our income in the next 4 or 5 years or more. But it's really a strategy that is managed over time. We're not just setting this strategy up and forgetting about it, because as we get closer to, let's say, years 11 through 15 of your retirement timeline, right, which would represent the third bucket, if we want to look at it like each bucket is 5 years of time, years 11 through 15 would be a bucket or a strategy that is maybe a 40% stock, 60% bond portfolio, or maybe it would be a 60% stock, 40% bond portfolio, depending on your risk tolerance. But as we get closer to needing to start drawing down on that bucket, because the first two buckets have been depleted over 10 years, as we get closer to needing the income from that bucket, maybe it's year 8, we'll shift that money over to a safe bucket, once again, filling up the stability buckets and taking the money out of the strategy and moving it to cash. So that now we have another 5 years locked in of paychecks or income without worrying about, oh my God, if the market crashes in the next year, where are we going to get our income from? Well, we've got 5 years in that bucket that represents the next 5 years of distributions. So I know this is complicated, but if we get together at some point, I can show this to you on paper. So it's the concept and looking at the numbers and the illustrations, which make it really easy to comprehend. And anybody that I've set this up for has really benefited from utilizing this strategy. It really makes the most sense when it comes to having a plan to set up your distributions over the course of your lifetime. If you have all the money in one bucket, that's not much of a plan. That's just kind of a hit or miss, and it's kind of like Russian roulette with your retirement money. If you don't have a certain amount of safe buckets of money to draw from, you could be in trouble depending on the sequence of returns. Now again, if every year the market is doing well and there's no market crash and there's no drop in the market, this plan isn't necessary, but we all know that isn't going to happen. It's the fact that markets go up and down and sometimes stay down longer, and we don't really know what the volatility is going to be like and when the next market crash is going to occur. So we need to have a strategy, have a plan, so that we have multiple buckets along a timeline and we know exactly when we're going to need to tap into those buckets and account for that and start to move those buckets into the proper allocations or holdings to ensure another 5 years of stable income. So let's say 4 or 5 of these buckets are going to have your portfolio. We use the example of $1 million, and we're going to break that up into let's say a total of 8 buckets, but 5 of them are going to be more of the longer term buckets where we won't have to take any distributions from them until we get to that point on the timeline where we do need to start tapping into those buckets because the other buckets have been depleted. While the longer term buckets are growing, the stable buckets are depleting from taking income. One of the nice things about a strategy like this is we can have a bucket that we allocate to 25 years from now, right? That maybe we'll put in $30,000 today, okay? And if I put $30,000, let me just do a quick calculation here. 30,000 present value, 25 years from now let's say we invest that particular bucket of only $30,000 in something that's maybe 100% equities, so it's a small amount of money of the overall portfolio. If we do that for 25 years and we invest that aggressively at, let's say, 10% hypothetically, and I can't guarantee a 10% return, but hypothetically, if that portfolio received a 10% return, the future value of that 30,000 would be 325,000 25 years from now. So isn't it nice to think that the longer term money we could take a little bit more risk with and feel comfortable about that? And again, it was only $30,000. The majority of the assets in the buckets are going to be probably somewhere between 50 to 60% equities or stocks versus 100% in that aggressive bucket, which only may get $30,000, $40,000, but we don't have to touch it for 25 years. It lets you invest accordingly. So I just wanted to make that last remark about the buckets. If you're interested in having me put together an income distribution plan, what we call an income for life model, it's a very nice illustration, and I'll present it to you and then deliver that to you so that you can digest it. We even have some other animations of how this works that you can click on. It's a video a different video that will take you through the plan with diagrams and explanations. Feel free to give me a call at the office. Again, it's Sean Danziger with Net Worth Financial Group. Feel free to call the office at 201-746-9180.